Okay, in this period, we shall see insurance, what is insurance, and what are the principles of insurance. Important principles of insurance. What is insurance? Represented in a form of policy, insurance is a contract in which the individual or an entity gets the financial protection. In other words, reimbursement from the insurance company for the damage, for the loss, for the contingencies caused to their property or lives. It is a contract. Insurance is a contract where there are two parties. One is insurer, the other is insured. Insurer is the insurance company. Insured is the people or insured or the people or objects, things, substances, articles, etc. Insured may be persons, organizations, or articles, things, substances, buildings, all those things. Substances may be many, articles may be many, but if we take the policies on them, they are all called the insured. So, insurance is a contract between the two parties, insurer and the insured. Why do we do the insurance? For the financial protection. To get the protection for contingencies, risks which will occur in future, not the past one. If there is any risk is happened in the past, we can't do the insurance on it. But insurance can be done for the future course of time and future course of actions, forthcoming risks. We do the insurance for the financial protection. In other words, reimbursement from the insurance company. For the big damage or small damage, whatever the damage it may be. The insurer and the insured enter a legal contract for the insurance called the insurance policy. Yes. If they enter into the legal contract, it becomes the insurance policy. That provides financial security from the future uncertainties. The insurance provides financial security from the future uncertainties. In simple words, insurance is a contract, a legal agreement between two parties, that is, individual named insured and the insurance company called insurer. In this agreement, the insurer promises to make good the losses of the insured on the happening of the contingency. And the insured pays a premium in return for the promise made by the insurer. So, insured pays the premium in terms monthly, quarterly, half yearly, yearly, or at one time. He pays the premium. And for what? For the promise given by the insurer to pay the financial assistance, financial return. The contract of insurance between an insurer and the insured is based on certain principles. Generally, the contract or the agreement is made based on some general principles which are accepted by the society and the act. Generally, the accepted by the public is made as act. So, we shall now discuss different types of principles of insurance in detail. Let us move. Principles of insurance. The concept of insurance is risk distribution among a group of people. Hence, cooperation becomes the basic principle of insurance. Cooperation between the members, between the people, between the institutions is the basic principle of insurance. If there is no cooperation, there is no insurance. If there is cooperation, there is insurance. So, since centuries, this principle is being practiced by the insured people with cooperation to transfer their risk among the people and getting the benefit from such kind of transfer. To ensure the fairness and for the proper functioning of an insurance contract, the insurer and the insured have to uphold the seven principles, major principles. They are seven. So, the insurer and the insured have to uphold the seven principles, which are mentioned, discussed, explained below. They are utmost good faith, proximate cause, insurable interest, indemnity, subrogation, contribution, loss minimization. These are the seven principles of insurance, and these are the base for the insurance. All should be performed, all should be accepted by the both parties. Yes. Now, let us see each principle in detail. Yes. Principle of utmost good faith. The very basic principle is that both the parties in an insurance contract should act in good faith, towards each other. This is a basic principle. We should have, the both parties should have the faith in each other. Utmost good faith. Towards each other. That is, they must provide clear and concise information related to the terms and conditions of contract. They should provide, the both parties should provide clear and concise information related to the terms and conditions of the contract. Regarding contract, regarding the agreement of the insurance, the both parties should disclose the information clearly and concisely. The insured should provide all the information related to the subject matter, and the insurer must give clear details regarding the contract. The insured should provide all the information related to the subject matter, and the insurer must give clear details regarding the contract. Both the parties should give accurate, authentic, reliable information. Yes, let us see an example. Jacob took a health insurance policy. At the time of taking insurance, he was a smoker and failed to disclose this fact. Later, he got cancer. In such a situation, the insurance company will not be liable to bear the financial burden as Jacob concealed important facts. So, in this example, Jacob didn't disclose all the facts. He didn't say about his smoking. So he concealed it and took a policy. Later, he got cancer. So, in this example, the insurance company simply rejected the liability. It does not pay the insured the amount, maturity amount to that person if any consequences are happen, if any risk is happen, they won't pay the maturity amount on that policy because he is died or faced problems with the smoking. So he didn't disclose that fact. So for that, insurance company were not liable, and it doesn't bear the financial burden of Jacob. Next, principle of proximate cause. Principle of proximate cause. Proximate is near, very near, concerned, related. So now let us see. This is also called the principle of causa proxima or nearest clause. Causa proxima or nearest cause. This principle applies when the loss is the result of two or more causes. The principle applies when the loss is the result of two or more causes. The insurance company will find the nearest cause of loss to the property. If the proximate cause is the one in which the property is insured, then the company must pay compensation. If it is not a cause the property is insured against, then no payment will be made by the insurance company. Example. Let us see an example. Due to fire, a wall of a building was damaged. And the municipal authority ordered it to be demolished. While demolition, the adjoining building was damaged. Adjoining building was damaged. The owner of the adjoining building claimed the loss under the fire policy. See, each other it is related. Should see carefully. Due to fire, a wall of building was damaged, and the municipal authority ordered it to be demolished. While demolition, the adjoining building was damaged. The owner of the adjoining building claimed the loss under the fire policy. Yes, the court held that fire is the nearest cause of loss to the adjoining building, and the claim is payable as the falling of the wall is an inevitable result of the fire. In the same example, the wall of the building damaged due to fire fell down due to storm before it could be repaired. The damage in adjoining building, the owner of the adjoining building claimed the loss under the fire policy. The fire was remote cause and the storm was the proximate cause. Hence, the claim is not payable. Storm was the proximate cause. So, it was not damaged with that cause. Remote cause, that was damaged by fire. So, the fire was a remote cause, not the near cause. And the storm was a proximate cause. Storm was not happen. The building was not collapsed with the storm. If it is collapsed with the storm, insurance company will pay the amount to the insured one. So hence the claim is not payable under the fire policy. Yes, let us see next principle. Principle of insurable interest. Principle of insurable interest. This principle says that the individual, that is insured one, must have an insurable interest in the subject matter. This principle says that the insured must have an insurable interest. He must have interest himself, not be forced by others. Insured interest. To do that policy, to get a policy. Insurable interest means that the subject matter for which the individual enters the insurance contract must provide some financial gain to the insured. Individual enters the insurance contract must provide some financial gain to the insured and also lead to a financial loss if there is any damage, destruction, or loss. So, we, individual must have the insurable interest. We can understand very easily with an example. The owner of a vegetable cart has an insurable interest in the cart because he is earning money from it. The owner of a vegetable cart has an insurable interest in his cart because he is earning from it. However, if he sells the cart, he will no longer have an insurable interest in it. To claim the amount of insurance, the insured must be the owner of the subject matter, both at the time of entering the contract and at the time of accident. Yes. In this example, this cart owner, vegetable cart owner, insured 2 years back, and now that cart is not at him because it was sold by him 2 months back to another one. And it was now damaged. It is now damaged. The earlier owner not cannot claim the amount on that loss because he is not the owner of that cart at present and it was sold. Now we shall move to the another principle. Indemnity. Indemnity. This principle is most important. All are important, but is most important one. It is not applicable to one thing. This principle says that insurance is done only for the coverage of the loss. Hence, insured should not make any profit from the insurance contract. Not profit, but coverage of loss. Indemnity, coverage of loss, but not profit. This principle says that insurance is done only for the coverage of loss. Hence, insured should not make any profit from insurance contract. In other words, the insured should be compensated the amount equal to the actual loss and not the amount exceeding the loss. Not the amount exceeding the loss. The purpose of the indemnity principle is to set back the insured at the same financial position as he was before the loss occurred. This is the principle. To set back the insured at the same financial position as he was before the loss occurred. Principle of indemnity is observed strictly for property insurance and not applicable for the life insurance contract. This is important one. It is not applicable. This indemnity is not applicable for the life insurance contract because we cannot indemnify with the financial support if on life insurance we cannot assess the indemnity regarding the life insurance contract. So now let us see an example. See the example. The owner of a commercial building enters an insurance contract to recover the cost for any loss or damage in future. If the building sustains structural damages from fire, then the insurer will indemnify the owner for the cost to repair the building by way of reimbursing the owner for exact amount spent on repair or by restructuring the damaged areas using its own authorized contracts. See, owner of a commercial building enters the insurance contract to recover the costs for any loss or damage in future. If it gets damages from fire, then insurer will indemnify the owner for the cost to repair the building to bring back the previous status of that building. Not exact, but equivalent. By reconstructing the damaged areas using its own authorized contractors. Now, let us see another principle. Yes, principle of subrogation. Principle of subrogation. Yes, subrogation means one party stands in for another as for this principle. After the insured, that is, the individual, has been compensated for the incurred loss to him on the subject matter that was insured, the rights of the ownership of that property goes to the insurer, that is the insurance company. Yes, see carefully. If any loss happens to the insured, for example, we have a warehouse, we stored 100 computers in it for sales. We took a policy, insurance policy. Accidentally, due to fire, all the computers were damaged. Its cost was 100 computers are there, so 5 lakhs. Cost is 5 lakhs. Some are partly damaged, some are fully damaged. And insurance company pays the amount of 5 lakhs to that insured one, and the remaining parts which are partly damaged are taken back by the insurance company because amount is paid for the loss. So total loss was paid, compensation was paid, and the ownership of the damaged goods goes to the insurance company. Yes. Now see this. See this example. Mr. A gets injured in a road accident. Due to reckless driving of a third party. The company with which Mr. A took the accidental insurance will compensate the loss occurred to Mr. A and will also sue the third party to recover the money paid as claim. So in this, subrogation gives the right to insurance company to claim the amount of loss from the third party responsible for the same. In this one, is there any mistake of A? Is there any mistake of A? A gets injured. due to recklessness, driving of a third party, not the A. The company with which Mr. A took the accidental insurance will compensate the loss occurred to A. First, they pay the loss to A. Company pays the loss to A because injured. A was injured, but the injury made by the reckless driving of another one, third party. So the insurance company sue the third party to recover the money paid as claim. Company paid some amount to A to get back that money from the third party because he's the reason for that loss, not the reckless driving of A, but reckless driving of another one. So the insurance company has the right to claim the amount from the third person. It has the right as per the insurance principles that insurer has the right to get loss, to get the amount paid from the third person which was paid to A. So we have seen some principles of insurance. First principle is utmost good faith. And proximate cause, very near cause. The cause for which we have taken the policy is the proximate cause. The other one not applicable for insurance. The third one is insurable interest. You must have, persons or entities must have the insurable interest. And principle of indemnity, principle of indemnity, and principle of subrogation. Principle of subrogation. We have seen some principles of interest insurance today, and in the next class we shall see the remaining principles. Thank you.